Okay, we're recording a class. It's 9:36 a.m. on Tuesday, November 10th. It seems that the futures markets are down. The Ninja Trader platform is not working. We went through some Forex, went through everything, and a lot of markets are just consolidating after um, last week's non-farm payroll, where there was a massive move, and markets are just taking a day or so to consolidate. And what we're doing this morning is rather than do nothing, we're going to be proactive and do a little class. So I have a whiteboard up. We have our trading room. If you guys can look over here and say hello, everybody, you're all in the room there. So got you a little part of that video. So just give me a moment just so I can get everything set up here and just make sure our pen. All right, that's clear. And we want to make sure if we draw a line, we're good. Okay. Okay, so let's take a look at, and I welcome everybody to our room, and I appreciate you guys being here with us. So let's take a look at the history of harmonics. Let's take a look at the history of the harmonics a bit, where it came from. There was a gentleman, his name was H.M. Gartley. H.M. Gartley. And 50, 70 years ago, 50 years ago, 60, 70 years ago, I forget at this point. I first looked at his book and gosh, it was maybe 2002. Linda Rashke, my former mentor and partner, had it at her house. And he put together a book on technical analysis. And in that book, on page 222, he was talking about a reversal pattern. And essentially, what he was saying was, you're welcome. He was saying that the market makes a low, market makes a high, and does something like that. And the same thing where the market did this. And that's all he was talking about. It wasn't until late 1990s where a gentleman by the name of Larry Presavento, you can't see that? Could you guys see this or no? People no, people yes. Let me try something. Can you also see that? Okay, so we got you. So it wasn't until Larry put some thoughts together and created this thought process of what he thought that Gartley was trying to say. That in terms of reversal pattern, all right, and that became what was known as the Gartley If I spell it wrong, Gartley 222, because it was on page 222. One of his students, a gentleman by the name of Scott Carney, and another gentleman who was, I guess, a colleague of Larry's, came up with their own derivatives of what they were looking at, where Scott came up with the butterfly. Essentially, the butterfly was this plus the leg went deeper. And then Scott came up with his own derivatives of the crab pattern and other patterns, put structure around it a little bit better. So, what had been developed back then in the late 90s, people use it today. It's very popular, but also it's a very misunderstood thing. You'll see people on the internet all over the place. They see that pattern and they just draw it haphazardly. And they're trying to buy the bottoms, they're trying to sell the tops. But I want to go through their structure of really what the intention is with these patterns. And I want to show you that it actually also relates to what's called Elliott wave. So let's take a look at the harmonic pattern and where you should be looking at it and where you don't want to look at it. All right? Two sides of the coin. All right? Two sides of the coin. This is an uptrend. And this is a downtrend. If you can't read that, you know what I just said. Uptrend, downtrend. So if you look at the market works in waves, okay? Market works in waves. That's what it does. That's the market's job. All right, comes down, goes up, comes down. And traders tend to look at this. Traders tend to buy. Now, I'm going to take you a little bit and show you what this is. This is called an Elliott wave. I'm going to mix them both, harmonics and Elliott's, together so you understand really how to better understand the market and how it operates. And you look at a structure 0, 1, 2, 3, 4, 5, and then from there you have what's called an A, B, C corrective wave before the markets want to move higher. Forget about this for a moment. So when we look at Elliott wave, the market is full of like little waves here. It's full of them. And in each of these sectors, these uptrending sectors, all right, you're expecting the market to have these like little waves up. So you have major, minor, intermediate, and the same thing here. So essentially you had 5 waves to complete the first big wave, retracement, ABC, just like you see there. 5 waves to complete the 2 to 3, ABC. and then 5 waves to complete the fifth wave. Once that fifth wave is completed, you tend to get a bigger retracement. You tend to get like this bigger retracement and what's called an Elliott wave. It's called a corrective ABC. You may see when we do our trades and I do our analysis, is I'll talk about how price relates to another swing, and I'll call it an AWE, like I did on Sunday night. I called it an alternate wave equality, AWE. All right, so here is your uptrending line, your primary trend. This is your secondary trend. Primary trend, secondary trend, primary trend. So, what this is called the intermediate wave of a primary trend. This is called a secondary wave of a primary trend. What's the primary trend? From low to high. All right, so you understand. So, after you've completed these waves, now Elliott basically said to define it 0 to 1, 1 to 2, 2 to 3. 2 to 3 is typically the longest leg right here. The 3 to 4 leg basically should not go below the 1. Okay, I'm teaching you 2 things in one. Just follow me. So traders tend to focus on this, on the pullbacks in a trend. That's what we do. A lot of people look at moving averages. You got your moving averages here. You buy the pullback. But after you've completed that fifth wave, bigger things start to happen. And you get what's called an ABC correction. Now, this is where Elliott wave and harmonics meet. And then I'm going to draw out how it should look, and then we're going to look at some harmonics. I'm going to put it all together for you. So, if we look here and our harmonic pattern looks like this, we'll try that again. It's an X, A, B, C, D. We all know that that would be a Gartley pattern. It goes down 618. It puts in all your relationships. I'll get to that in a bit. And that would be your Gartley pattern where you see people buying it and you're putting your risk below the market. All right? When we look at Elliott wave, Elliott has what's called an ABC correction. Well, when Larry Pesavento saw that little picture in the book, he came up with this. But if we really look at what the highest odds play is you want to have that rally. You want that. You want that pullback. You want this to be the X in a trend. If you look at it, that becomes the X. You don't want prices to go below there. This becomes the A. This becomes the B. It becomes the C. It becomes the D. You see this? So if we think about it, all you're doing whatever. That's your moving average. If we look at this, we understand that harmonics and Elliott wave go together. You always want to know what part of the structure you're in before you do anything. So when you look at the scanner that we have and it puts up a pretty picture, you want to know, do you really have support there? Or do you have resistance? Before you go and become real bold and aggressive, you want to make sure that you do have support or resistance where you're going to be buying or selling. I prefer looking at markets that are finding support, key support, and buying it. We saw this is a good example. This is a proper example of both Elliott and how harmonics both use the same pattern and where you can get strength from. That's why a lot of times you see some of these harmonic patterns that we got have explosive moves. It's because this is what's happening. All right? It's powerful. If you understand this, it's game over. You understand it all. It's the guy that I told you is in a big downtrend, market's in a big downtrend, and all of a sudden they found this pattern in the downtrend. And they think they found the buy. They think they found the buy. All right. So if you're looking at just this little picture right here, it's an obvious. Market's going down and you're buying, it's a higher odds play. I'm talking daily charts, 4-hour charts. If you look at the market that's going up in an uptrend and you're buying, you feel more comfortable of putting your stops all the way down here because the market's in an uptrending environment and this is planning to continue higher. And all this is just a bigger picture of what this is and what that is. That's all you're doing. If you look here, you see these patterns show up all the time. You just got to know how to identify these harmonic patterns. And you got to understand what part of the trend you're in before you do anything. So, let's go back. All right, let's go back again and take a look. All right, guys, hold on a second. Let me just check something. All right, looks like the CAD ended up getting stopped at around break even. Okay, took a quick look. All right, so let's understand the basis of the Gartley. That's the basis of harmonics. You're going to have a starting point. All right, you're going to have a starting point. You're going to have an impulse in a direction. All right, and in that impulse, it could have these waves within it. Okay, just have to look at it with those waves in it. But we're having our impulse in a direction. And then you have a retracement in the trend. Now, this goes from X up to A. We're just identifying as we go. You don't know this as it's happening until it happens. And this is going to become B. And the way we're going to know that it's starting to develop that structure is that that first retracement is at 61.8 retracement. So this is called an X A B. Okay? It's a 61.8 retracement. Now, what's important is the next two lines. I really don't focus on one of them, but I'm going to show you. When the market, after the market pulls back, it's going to give an attempt up. And it's going to give an attempt up, and it's going to end up identifying itself as C. And right here, this zone here, it's a 38 to 89% retracement. A, B, C. Which means from A high to B low back up to C. It could be anywhere from a 38.2, what we call 38% retracement, to a 88.6, what we call an 89%. So anywhere in this zone is fine. Anywhere in there, it's fine for the market. From that point, the market drives down. What is ultimately called your D completion point. Now you have the X to B. You have your B, C, D, and you have your X, A, D. This is at a 7.86 of the X low, A high, and D. X, A, D. Now, there are, in here, you have your B, C, D. It varies from a 1272 to 1618. I'm not going to get into this because 99% of the times, this is really the structure that you need right here. All right? This is the structure. And by defining this, what you're doing is you have a B, C, D. Now, sometimes you'll see it as a 1.1272 to a 1618. and I'm getting a little bit past some of the understanding. What do the percentages stand for? Well, in the markets are like the ocean. Uh, Piler. The market's like the ocean. You have the tide, you have the wave, and then you have the ripple. And here is you. Got your feet in the sand, and you got the tide coming up, you got the waves coming in, the little ripples. All right, look at the markets the same way. All right, you look at the markets the same way. Tide, ripple, wave, or tide, wave, ripple. And these points, the markets will rally and they will retrace to a certain extension. In what was called the Dow theory, is Dow said that the markets will retrace one half, one third to two thirds, sometimes half of their gains before they continue. One third to two thirds of their gain before they continue. And in here, you have little waves. You have to look at it like the ocean. You have waves in the market. So in our example here of the Gartley, you have to have that impulse leg right here. You have to have that first retracement down. You have to have that attempt up and fail. And then you have to have that drive down below B, where all these ratios meet. You have all the ratios are meeting together, where you have that what's called a completion point. Remember what we just talked about. You got your trend up, right? Then your A, B, C down. And it looks like that in a bullish environment. What you don't want is this. So, which is more ideal to do? To buy here when the market's weak, or buy here when the market's strong? Yes, X and D typically have the same points. You're always looking for D. So from that point, a gentleman, his name Bryce Gilmore, came up with the butterfly. I'm going to put it right in here for now. He came up with the butterfly that it went up, came down, went up, and made a lower low like that. So here is your X, here is your D, here is your A, here is your B. So there are derivatives of this particular pattern. There's patterns that look like this, higher high and then low. There's all sorts of patterns, but we'll do that another day. I just want to establish the fact that you understand how a Gartley is derived. You understand that, Quincy, I'm recording this. I'll send it out in an email to everybody, okay? Once it's completed, you'll get a copy. It'll be in your email later today. So you'll be able to watch the whole thing again. Don't worry about it. I got you. So I hope, unless something happens, like the recording breaks. So I'm recording this for everybody, so you can go over and over it on your own. So don't worry about it. I got you guys. If you're new, we do classes a lot. I just for the past week and a half, I had no voice. All right, but I want to establish the fact that when you're looking to buy or sell, when you're looking to buy, you want to make sure that you're in the context of a bullish market. All this looks pretty, right? It all looks pretty, but you got to establish the fact: am I in a bullish market or in a bearish market? We looked at the EUR today. It's dying. We don't really care about that. We'll worry about it when it gets up here. Like I said, I drew it in earlier. We'll worry about the EUR when it does this. You see. We'll worry about it here. I'm not going to worry about it here. You want to go with the trend, not against it. And, you know, it's easy to say sometimes, right? It's easy to say sometimes. Easier said than done. But you have, right here, is the foundation for harmonic patterns. If I can clean my screen, I'll be real happy. So let me do this. Let me remove the whiteboard. And let's take a look at some examples. Oh, I'm not going to be able to because, oh, yes, I am. Hold on a second, guys. Okay, guys. I like this shorts up here with the CADJPY. Okay, for the room. CADJPY. It's okay to go and rework the short side. Put your stops above. Keep a tight stop, okay? All right, so let's look at some other things. All right, let's look at some other things. I want to make sure we're pretty good here with my zone that we're watching. All right, guys, let me just make sure we have this proper. Hold on, please. Okay, so I had to stop the camera for a little bit. Okay. So let's take the EUR USD for a moment. Let's just take this for a moment. You don't want to be the guy buying down here, looking at the market and coming up with his interpretation of the bottom. So let's take a look at the picture. The market's very weak, right? Market's extremely weak. Short term, market's extremely weak. All right. Let's take a look at this zone down here. Okay. This would be called basically a butterfly pattern. I don't particularly, as I said, 1, 2, 3. You have your proper structure there. One, two, three. This would be considered your butterfly pattern. That would be your X, A, B, C, D. My issue with this is that you're in a severe downtrend. All right? You're in a severe downtrend. So you want to basically not be so bullish on this. What you want to do is see this turn up. You want to see that turn up. You want to see that higher low. And you want to see this turn up again. All right. So before you get bullish on the butterfly, on this butterfly pattern, you want to see that reversal off of here. This is in a bearish market. You want to establish the fact that this market is going to find support. The only way I would like to buy this is after the market establishes itself as a higher low and it's wanting to change the trend from going from down to up. The last thing you need is to be this guy and keep getting stopped out. It's a difficult game, all right? And believe me, it's a difficult game. So right there, although this looks great, that somebody says, "Wow, I've got the bottom." Okay, but if we look at this right here, 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 eventually, all right, here. So, what would be better? Trying to buy them down here, or eventually when the market retraces. Now, it's an obvious that the market has to go from here to here. That's why I say, don't try to pick the bottom. Don't pick the bottom. You let the market rally, put its lower high, or even go higher, like this. Prove that the bottom is in. Prove that it stops going down. Wait for that little test down. All right. If you're in a bearish market, that's the way you treat this. If you're in a bullish market, if you're in a bearish market and it comes up here, then you can be more aggressive. But here, you're just flying by the seat of your pants. So let's take another picture, another example. Yeah, depending on the size of your account, guys, I'll go over that in a minute. Okay. All right. So this would be the proper structure of a Gartley pattern. Although it entered, there is the entry that we just went over. Here is your risk. Let's take a look at the bigger picture. You're in a downtrend. You see that? You're in a downtrending market. All right? You're in a downtrending market. All right? You're in a downtrending market. You're always looking for retracements in a downtrend to sell into. That's all you're doing. Right? That's all you're doing. So rather than being the guy that buys the bottom, you want to be the guy who uh, shorts the retracements up. All right, guys, I'm going to wrap it up here. My name is Christopher Terry, CEO of iMarkets Live. Rock and roll.